Hello everyone, today I would like to talk about US high yield and about what is happening behind the scenes of this booming market. First of all, why booming? Booming in terms of new issues. August has been so far the busiest ever August, and it allows US high yield issuance to beat the 2019 issuance record in less than 8 months. And also booming in terms of performance, because year-to-date US high yield managed to come back in positive territories as if the pandemic never triggered the biggest slowdown since the Great Depression, and this is thanks to central banks. So, does this mean we are navigating in clear waters? Short answer is no. If we take a look at the latest Moodys default reports, July, the report shows an acceleration in default, and especially in the US. The default rate in US high yield in July rose to 8.4%, which is almost a double compared to earlier this year. And also the forecast shows this could rise to 12% early 2021. But what is also interesting is the rising trend in distressed exchanges, because they are not registered as a classic default. So a distressed exchange is a proposal from an issuer to the investor on the debt. So either lengthening the maturity of a bond, or buying back some bonds at their depressed value market, or anything that creativity allows. But in most cases, it's just a bandage for a company that will probably default later. Moodys includes those exchanges in its definition of default because they imply that the issuer is not respecting its initial commitment. So we are in a zero-sum game where the investor always loses, even though he has the choice. He can or not, he can accept or not the exchange. And sometimes accepting the exchange may make sense for some people. You can think that the borrower needs a bit more time to arrange his situation, or you may also fear to lose more money if you push the issuer to default now. Still, according to Moodys, before 2008, only 10% of defaults were distressed exchanges. In March this year, they were already reaching 40%. So, up to now, what we've seen is that supporting financial market, especially credit markets, through liquidity does not allow to solve solvency issues or unbearable capital structures. Many of the companies that are currently defaulting or proposing distressed exchanges are those who piled up cheap debt in the previous cycle rather than addressing the weaknesses in their business model. So this race for them ends when they can't access the market anymore to refinance maturing debt. So isn't that race to borrow as much as you can feeling familiar? Actually, this kind of reminds us, just looking at the new issue numbers in the US high yield, of what we could be living now, and also of what could happen in the next cycle. Thank you.